Hi there, it's Monday, it's April 6th. My name is Adam Hebener, I'm the CEO of Modern Mortgage, and this is today's Modern Minute. Two big things I want to update you on for those of you who are self-employed buyers or those agents out there who, of course, are self-employed. Many of you are sole proprietors or S-corps. If you've not considered taking advantage of the Payroll Protection Loan that was included in the CARES Act and is running through the SBA, that's the Small Business Administration, if you've not looked at that personally for you because you're kind of overwhelmed or you tried to call a banker and couldn't get anybody on the phone, if you're not sure what to do with that, we want to help out. I found a resource for you. It's a great calculator that can help you kind of walk through at least some of the initial ideas with this SBA PPP loan, Payroll Protection Loan. So check it out for yourself. It's included with this video. You'll see it below. It's just a link. Click on that link and just see if payroll protection is something that's right for you. There can be portions of this loan that are paid back to, or that do not require you to pay back. And so that might be worth looking at. So hopefully we're just sending that out as a service. Obviously we don't do SBA loans. We're only a mortgage lender, but we still want you to have access to that. And so hopefully that resource will help. That's the first thing. I want to encourage you practically. Go look at that and see if it's something for you. Now, secondly, let's talk about the mortgage market in general, a much more broad look at what's happening, because I think probably the biggest concern we're seeing from our agent partners and clients and really just the world at large is, are we about to see a housing crash in Denver, in the United States, and across the world? Are we going to see a housing crash like what we saw in 2008? Well, let me see if I can give some insights, because I cannot give you an answer. I can't predict the future any more than anyone else can, but I can talk to you about some of the big macroeconomic elements at play as we think this process through. I think there's some things that argue against a crash, and then I think there are some things on the horizon that we need to be watching really, really closely, because I think they do have the potential to create a crash, and we need to be thinking these things through together, watching them. I will tell you that as I sit here today, I don't see a crash coming just yet, but I'm going to tell you why I think that is. So let's start first with what sort of commends the idea that a crash would not occur. Well, here in Denver and in many other cities across the United States, there has been a lot of in-migration over the last many years, really since the 2008 crisis. So you've got a lot of population. That population increased demand. That increase of demand increased the amount of equity. And as I talk to you now, if you're a homeowner today, you probably have more equity in your home than maybe you've ever had. Most homeowners have quite a lot of equity in their home. Combine those two facts, lots of population, lots of equity, with the fact that now the CARES Act granted a forbearance process that allows people to stay in their home and kind of wait patiently to be able to make payments back. You take all those three things together, and what you see is a big influence on people's behavior. And when we look towards how people are likely to behave, we can tend to see what's likely to occur in the larger economic market as a whole. So because people have a lot to fight for and all that equity, because there are a lot of people who are looking for homes anyway, and because forbearance gives you that time to kind of breathe and respirate a little bit, all those things probably accrue to a slightly more calm than this crisis might suggest home buying and home owning population. Now, I think that's good news, and I think that argues for the fact that a crash in housing is unlikely. But even as I say that, I want to tell you that embedded in that idea is one assumption, and that assumption, if it is not upheld, would argue for the fact that housing could be in trouble. Let me tell you about that assumption. I am assuming that the federal government is going to take action to take care of FHA, Fannie Mae, and Freddie Mac. Now, as I say that I assume they will do that, I must admit, I sit here on April 6th entirely shocked, flabbergasted, gobsmacked, whatever strange word you'd like to interject here at this moment. I am absolutely surprised that the federal government, either in the CARES Act or some other way, has not taken action to protect those three now. Now, you may not know this, but the mortgage market in the United States, Fannie Mae, Freddie Mac, FHA, and their ancillary secondary markets, those entities really are one of the primary sources for liquidity in all of the country and thereby all of the world. It's that cycle of moving money through the mortgage market that tends to allow banks, secondary banks, shadow banks, all other kinds of financial activity to occur. Now, it's not the only source of liquidity, but it is one of the major sources of liquidity and major sources of way money moves through the kind of plumbing of the financial system. And as it stands, the government has actually not taken helpful action in that market. And not only that, they've actually said, we're going to kind of wait and see to see if we even need to. Now, this is shocking to me because they've taken huge action on other sides of the economy and in very what I would describe as ineffective way. For instance, sending $1,200 to every household that makes $75,000 or less is probably not going to be very effective in doing anything to stave off the crisis that we're in. Instead, what they should be doing is kind of taking a dual approach to the mortgage market. The dual approach would look something like this. Maybe a credit facility that would protect originating a loan. Now, if you originate a loan and the person for whom you originated that loan loses their job anytime in about the first year, that mortgage will never make money. In fact, there's a good likelihood that it will lose money for those who own it. Now you say, well, I don't care about the people who own it. That's just some big corporation somewhere, right? No. The reality is the people who own mortgages are those folks who most of the time are institutional companies like pensions. Sometimes they're 401k holders. They're people like you and me. If you've got bonds in your 401k, there's a good chance you're earning money from people's mortgages right now. So the reality is, if you were to protect those first few payments being made and say, hey, look, if there's default because of COVID, the government will protect those defaults. If that were to happen, that would settle the entire mortgage market down, and it would allow mortgages to be made in a forward way, and we could continue to originate new mortgages in a way that would give confidence to those final bondholders. That's the most important part. Now, secondly, those bondholders, the ones who have them in the interim, we call that the secondary market, they need what we would call liquidity. They need buyers to buy those mortgages away from them. Both of those two things are happening, and both really for the same reason. That reason is, when you make a mortgage right now, the risk to that mortgage is impossible to know because you don't know what percentage of people are going to lose their jobs. Even if they want to make the mortgage, they may not be able to. So the fact that that problem persists, I must admit, is still shocking to me. Really, that is where the government should be taking action. That's where you should see Fed intervention or Treasury Department intervention. And in fact, what we've seen is the oversight, the office at the government that oversees Fannie Mae and Freddie Mac is called FHFA. And they not only have not done anything to help that, they've actually really, with their rhetoric and I must say poor actions, have really endangered that market substantially. So I will tell you this, the mortgage market is, you need to know, driving in a bad direction. But it's still alive today, and my belief is, because it is so obvious and because it is so important, that the federal government's going to have no choice but to come in with an emergency facility that would address both the front-end default ratio and the back-end liquidity question. I think they must do that. The fact that a guy like me can see this from here means much smarter people from much better positions can see this as well. And so I do expect that to be addressed. Once it is addressed, that will really prevent the idea of a cascading mortgage collapse from occurring. So I do want you to understand how we're thinking this through. I don't see one coming, but I don't see one coming because of this huge issue that I think can and must be addressed. I will admit, even as I say that I'm surprised it hasn't been addressed so far. And we're going to keep updating you, making sure you're aware of what that looks like so that you can continue to prepare. In the meantime, make sure that you're taking care of your family, you're taking care of your home, you're taking care of your clients and your people as best you can. We're going to get through this. We can see the daylight already on the other side. Cases are starting to come down. in Europe as a result of the social distancing and quarantining efforts. Expect those quarantine efforts to get greater here in the United States in order to improve upon the numbers we see. And we'll continue to keep you updated as this process goes. As always, our goal is to help you interpret what you're seeing so that you can make decisions that are right for you. So hope this helps. I look forward to seeing you guys soon, and I hope you have a great day. Take care. Bye-bye.